The producer price index, the print coming in much higher than economists anticipated, throwing in a curveball at the Fed's interest rate decision in September. For more, we're beginning to hear Lauren Seidel-Baker, economist at ITR Economics. Lauren, it is good to see you. Let's start with the economic news today, Lauren. That would be that PPI print. It came in hotter than expected, Lauren. I'm interested to get your take on that print and just your broader view of inflation, Lauren. Where are we? Where do you think it's headed?
Sure. So this was actually not higher than we at ITR Economics had been expecting. We've already seen building pressure, especially on the PPI side of things. The consumer price index, we expect that one to start turning up very soon as well. We're starting to see more of these inflationary pressures, fundamental factors that have been in place for years now across the economy, just starting to impact inflation. And I want to be absolutely clear, when I talk about these fundamental factors, I don't just mean tariffs. There are a lot of other pressures, both fiscal, monetary. We see higher wage pressures. We see higher electrical, energy costs building in. So I think this is a much broader conversation. I still don't think we've seen the full impact from tariffs just yet.
And so, Lauren, now that you as an economist, you got your CPI, you got your PPI, what are you expecting for core PCE, which of course is Jay Powell's preferred inflation gauge?
Yes, so there's going to be some differences between those two, just methodologically speaking, but we do see the general direction typically align. Again, these are broad-based inflationary pressures that we're seeing just now. I see more reason for rates to be rising in order to not let inflation get away from us as it did the prior cycle than to see these rate cuts. So I think the Fed is watching very closely the movement beneath the surface. Yes, we might get a 25, maybe 50 basis points. I struggle to even see 75 this fall because more broadly speaking, inflation is the risk that's on our doorstep, much more so than the labor market. The Fed officials know that.
To the extent that we see that tariff-induced inflation, Lauren, the debate at the Fed seems to be whether that is going to be transitory, one time, or something more persistent. That seems to be a great debate among our policymakers, among our central bankers. Where do you land on that?
Well, if the Fed hasn't been scared away from the word transitory, then I don't know what it would take. But yes, there is that discussion. Is this a one-time step up in prices or something a little bit more pervasive or persistent? I think either way, those tariff price increases are not even here yet. So as we try to dissect what exactly caused this building inflation, our analysis suggests that tariffs take between 9 and 18 months to really flow through to be seen in the economic data. So whether they're one time or whether they are, again, more long-lived, these are not here yet. That does mean that we still have further inflation to go from this point in August 2025 with regards to tariffs impacting price levels.
It's interesting, Lauren, because you'll hear other economists say, listen, inflation, I mean, it is not where Jay Powell wants it to be, but they'll say the Fed now is firmly focused on the weakening in the labor market, and that's why they say the cut is a lock in September. What do you say to that?
Sure. I think the labor market is softening, but we have to remember that it's softening from such an incredibly tight starting point. We still see general balance in the market. It's just balance at a slightly lower level. So one of the metrics that I use, it's not just the jobs numbers, how many jobs were created, but it's how many unemployed workers do we have for each available job opening. Right now, that number is hovering right around 1-to-1. Typically, in a kind of normal labor market, we see multiple job seekers for each available open position. So I know this feels different than it has felt in recent years. It certainly is very skills-based. There might need to be some reskilling that takes place. But generally, we're just seeing the labor market at balance at a slightly lower level. That is fewer job seekers and fewer jobs being created, both as we have demographic challenges with labor availability, limited numbers of young folks aging into the labor market versus those baby boomers who are now finally retiring. We also have negative net immigration expected this year. That's going to limit labor availability in certain key sectors. Now, on the other hand, businesses are feeling all of this policy uncertainty. They want to play their cards closer to the vest, so we also don't see a broad swath of new job creation happening, new available positions coming up. So all this means to me is that we're still generally imbalanced. Neither side is significantly out of whack at this moment, but it's just at reduced numbers. I think that's something we're not used to contemplating with regards to, say, how the jobs report comes out.
It's interesting, Lauren, because you get that PPI data this morning, and you do hear these, you'll hear new questions raised about trust in the data. And I'm curious to get your take on that. How much confidence do you have in data?
Trust but verify has become our new motto. So we are looking for other data sets that can either confirm or deny what we're seeing from the official numbers. I'm less worried about things like the revisions. Revisions are very normal. We just get more surveys come in after that first release. So the data does get fine-tuned. That is very normal. What I'm personally more worried about is the layoffs, the force reductions at the BLS. With regards to, say, the CPI numbers, 1 in 3 data points is now being imputed in the CPI calculation. That is a big increase from what is normal. So I don't think we'll see any major, flipping of a switch from good data to bad data. It's going to be a little bit more gradual. We'll tend to start to see that discrepancy widen over time as we make more and more assumptions in the data. If anything, I'm watching the CPI most closely, and we would tend to expect inflation to be understated, if anything.
Liz Thomas, SoFi Head of Investment Strategy. Liz, great to see you. So we get that PPI print, Liz, this morning. The market is betting on that cut next month, Liz. They expect it. Should the market be betting on that cut?
Well, the market is betting on it and the market wants it very, very badly. And I think the bond market continues to try to send that signal. The debate before today had been whether or not the cut would be 25 or 50 basis points. Now I think we've taken 50 basis points off the table with this print. But I have to say, I'm surprised that the likelihood of a cut didn't come down further after today's PPI print. Now, part of it could be that PPI just isn't the headline maker that CPI or even PCE is, because it's not consumer based. But what you have to really pay attention to in this report is what happened, which was outside of expectations. So a lot of the belief has been that tariffs have been absorbed by companies. Businesses are just eating them and letting them go into their margins. That's not what this report showed. So now you have to sort of expect that if businesses aren't eating them on the wholesale side, maybe they are planning on passing them through to the consumer, and we just haven't seen that yet in the consumer inflation reports. That can take anywhere from 3 to 6 months. So we've still got some time and still some question marks.
Let me ask you this. What about those economists I hear who say, listen, inflation, it is not where Jay Powell wants it. It's above target. But actually, their argument will be the Fed is now really focused on the labor market. That's what they're concentrating on. And that's why the cut is a lock next month. What do you say to that?
Well, we had 1 weak labor report. Now, it was mostly the weakness in it was about the revisions, not even the labor report itself. But I also would have to say we haven't seen a contracting labor report. Even with those downward revisions last month, nothing contracted. So we haven't been losing jobs. We're just adding them at a much slower pace than we thought we were. If we get another weak labor report in the August numbers, so we'll get that early September, then I think it is more likely that the Fed goes ahead with a 25 basis point cut. If we get a hot labor report, it complicates things a lot. So I think in this near-term scenario, when we're looking at between now and September 17th for the Fed meeting, the labor report matters a lot. Over the longer term, though, I take Jerome Powell at his word, and he has said multiple times, high inflation doesn't work for anybody. It doesn't work for businesses. Now I'm paraphrasing. It doesn't work for businesses. It doesn't work for the economy. It doesn't work for consumers. So I think over the long term, they are going to have to really look at inflation and the jobs market too. We're at 4.2% unemployment. There's room for that to move up before they're going to get really uncomfortable. So I wouldn't hold that as the only thing that they're going to be concerned with.
Liz, does the market need a cut to move higher?
This is controversial opinion. I don't think it needs a cut to move higher right now. I think the market really wants a cut. That's not to say that if expectations for a cut come down, yes, I do think we see volatility. But the market really has been driven lately by good, solid fundamentals. And yes, a lot of enthusiasm still over the AI theme and this technology supercycle. But I think that's warranted over the long term. Does it need a cut in order to keep having strong fundamentals from companies? Probably not. Does it need a cut to justify some of these high valuations? Perhaps. So I think that's the place that we're at right now when the stock market is looking at the likelihood of a cut. A cut would help everybody feel perhaps a little bit better about these high valuations.
Liz, let me ask you, investors wondering, okay, given that backdrop, how do I want to be positioned in this market? What's your guidance, Liz?
Well, first of all, you have to believe in the future of American technology. So you still want to be invested in those names, no matter how many times we've pounded the table about it, and no matter how high they've gotten over the long term. This is a theme that proves to be one for reason for optimism and proves to still offer us growth opportunity. But something that I talked about in a blog that I wrote today is just needing that diversification, particularly at this juncture, because we've got a market, again, at all-time highs. We hit the 18th all-time high today. And we should note, too, of those 18 times this year, 15 of them have happened after the end of June. So it's been really clustered. It's happened a lot in just a short period of time. So you want the diversification away from some of the drivers that have been the strong parts of the market. That doesn't mean that you want to take a bunch of money out of those strong names, but I'm also assuming, because we hear so much about this cash on the sidelines, that people do have some dry powder to put to work. So you want to diversify it into some other drivers. Sectors that can be attractive right now, whether it's for valuation reasons or because they're just driven by other things besides growth and momentum. Sectors like healthcare, totally washed out. So attractive from a valuation perspective. Something like financials, driven by, yes, interest rate volatility, but there are other opportunities in financials that aren't so tied to that growth trade. And then you can also even look at energy. Inflation reports aren't necessarily going to send energy in one direction or another. So you can diversify away from some of that headline risk.
Liz, great to see you as always. Thank you.
Thank you.
U.S. stocks are pulling back from record highs after the S&P 500 closed out its 17th record this year. But technical indicators do show the potential for downside ahead. Would it be a buy the dip opportunity? Joining us now, Adam Turnquist, LPL Financial Chief Technical Strategist. Adam, I want to start with the action that we're seeing this morning, actually. We got that PPI, the wholesale inflation report, coming in considerably hotter than expected. You put that together with record highs, and you've got futures down this morning. So what does that sort of setup look like to you?
Overall, when you look at the technical setup, we're pretty overbought on the S&P 500 right now. We actually had called a doji candle. I'm not going to get too far down into the weeds of the technicals yesterday, but oftentimes those are found at inflection points, and it's all about the follow through. Today we're getting, looks like a weak open for now, and not to sound bearish, I do think it is a buy the dip opportunity. You think about the market overbought, you look at even today's inflation report coming in hotter than expected, and where we're at seasonally as well would make sense. Maybe we're due for a little bit of a breather here in this bull market.
Adam, I know one of the indicators you watch is the 200-day moving average for the S&P 500, and the space between, if you will, the premium at which the S&P itself is to that 200-day moving average, which is just a momentum indicator for people who are watching at home. And the gap there, pretty wide. We're showing it here, and with that takeoff on the right side there, with the S&P continuing to push to record highs, you've got a pretty good gap there. What does that tell us?
Right now, we're at about a 9% premium above the 200-day moving average. The easiest way to think about that is a rubber band, and price being the rubber band above that moving average. It generally only goes so far before you start to see either a pause or a pullback. That threshold is about 10 to 15%. That's kind of the peak premium you'll see in that indicator. And we're getting close to those levels right now. And it doesn't mean that the market is going to roll over or a market top is being made. It is really just signs of the market getting a little bit extended and maybe due for some, at minimum, a consolidation phase.
So you've said something a couple times, or sort of indicated a couple times, you don't think this is the end of the bull market. You think that, if anything, there might be a little rockiness, a little pause. How do you know the difference, right? How do you know when the market is setting up for some rockiness or maybe a small pullback versus something more significant?
We look at a range of different indicators, of course, the macro environment as well. And I think just on the technicals here, we have very cyclical leadership. We have semiconductors leading. We have areas like industrials, financials. all doing quite well. That's the leadership you want to see in a sustainable bull market. And breadth, even though on a short-term basis has deviated a little bit from price action, still remains constructive. You have over 60% of the S&P 500 above a 200-day moving average. Same type of stats in our proprietary trend model. So underneath the surface, on a longer-term basis, it does look pretty constructive. Not to mention the macro environment. We have yields moving lower. The Fed likely going to start cutting rates in September. So I do think that does support a more durable bull market, although we know bull markets are not linear, so we have to expect some volatility here in the next few weeks, we'll call it.
Adam, I want to talk earnings for a moment, because if you take this morning's producer prices, you put it together with consumer prices, that indicates there is tension somewhere, right? Because wholesale is rising faster than consumer. So does that mean that the earnings, honeymoon that we have been on for this reporting season, that's going to come to an end when we start to see that margin pressure?
It's hard to bet against the corporate S&P 500 earnings right now. Corporate America continues to surprise all of us with the resilience. We were expecting earnings around 5% for the quarter for the S&P. We're going to do at least double that. The beat rates are above average as well. And I think what you'll hear, or what you're hearing at least from the C-suite right now, is how they're navigating around tariffs. I don't know if they have enough indication on where and how much tariffs are going to be. We're just starting to see the effect of that, and it hasn't really, those pass-throughs have not shown up. We definitely saw that in the CPI report over the last couple months. The more forward-looking wholesale inflation, definitely a concern, but I do think that's going to be the big question this fall, is how those tariffs show up. Is it going to be on CPI or PCE, or is it going to start showing up in margins? Right now, we haven't really seen a big margin hit, absent today's earnings report from Tapestry, what you were talking about earlier. But maybe that's what's to come, and maybe we'll weigh a little bit on the earnings growth story we've been so reliant on here.
In Washington, President Trump signaling he may be a little closer to picking a new Fed chair. Let's get to our Fed correspondent, Jen Schonberger, with the latest details. Jen.
Hey, Josh, just hours after a report said the Trump administration was considering a pool of up to 11 different candidates to replace Fed Chair Jay Powell, President Trump said the pool for consideration is actually much smaller. Speaking with reporters earlier today, the president said he's down to 3 or 4 candidates, reaffirming comments he made last week. Take a listen.
I'll be naming a new chairman sometime within the next, I think I'll name it a little bit early, the new chairman. I'm down to 3 or 4 names, all good, all great.
Tuesday, Treasury Secretary Scott Bessent, who is leading the search and interview process for the next Fed chair, said the administration is casting a, quote, very wide net for candidates, telling the Fox Business Network that the president has a very open mind. Meanwhile, a report from CNBC this morning citing 2 administration officials said Trump is now weighing up to 11 different candidates to replace Powell, including Jefferies chief market strategist David Zervos and BlackRock chief investment officer for global fixed income Rick Ryder. But the White House debunked that. Deputy Press Secretary Kush Desai telling me in a statement earlier today, quote, unless it comes from President Trump himself, any discussion about personnel decisions should be regarded as pure speculation. Now, Josh, last week, the president seemed to imply that the 2 Kevins, that is former Fed Governor Kevin Warsh and Kevin Hassett, the director of the National Economic Council of Advisors, are on his short list, saying that the 2 Kevins are doing very well. When asked whether Fed Governor Chris Waller is under consideration, the president did not deny it. Josh?
And Jen, we're getting new info as well from Fed Presidents Goolsbee and Bostic. What is the latest there?
Yeah, so while the market is pricing in virtually a 99% chance of a rate cut in September, we heard from Chicago Fed President Austin Goolsbee and Atlanta Fed President Raphael Bostic, who are very much in a wait-and-see mode for the next 5 weeks before the Fed's meeting on September 17th. Goolsbee in particular seems to be eyeing inflation. He's concerned about the prospect of the impact of tariffs on inflation being more persistent, pointing to 50% tariffs on steel, for instance, and what impact that could have on intermediate goods, acting as a tax on manufacturers. He pointed to the recent CPI report, saying if we get more reports like that where we see the services side of inflation stickier and popping up, that would be a concern. Meanwhile, Bostic, who has been quite hawkish and felt that with the labor market in a healthy position, giving the Fed room to wait and see, is now looking at the job market, given that weaker than expected jobs report for the month of July, saying that it's the Fed's task over the next 5 weeks to see if the labor market is indeed signaling more weakness than previously thought.
All right, thank you, Jen.
Ali, let's start with you and the leg of the rally that we've seen most recently, which seems to be fueled by hopes for lower rates, pushing things to records.
Right, and those rate cut hopes, that stems from CPI. And what's interesting is that there was really things in this report that could appease the optimists and the pessimists. We did see headline inflation coming on par with expectations, dropping on a month-over-month basis, but we did see firmer core prices. Core inflation hitting a 6-month high. Services inflation also firmed, and heading into this report, that had been softer and was really offsetting a lot of the increases that we saw in core goods. So under the hood of CPI, there are these concerns, but right now, this clearly was a better than feared report in a lot of ways, and that's leading to this latest record high, the S&P 500 closing for its 16th time this year at records. And leading up to today, it hasn't all been driven by Fed policy. A lot of it has been driven by earnings expectations, along with the AI story. Earlier this week, we saw Citi increase its price target on the S&P to 6,600, and they specifically cited earnings momentum, not just for the rest of this year, but also 2026 and beyond. Now, that's not to say we won't see some choppiness and some volatility. We have Jackson Hole coming up later this month. There usually tends to be some chop around that. We still have a lot of economic releases to come, and also considering the fact that stocks are still trading in this euphoric territory, that makes markets a lot more vulnerable to potential downside risks. But it's clear that rate cut hopes in September, that if we see that materialize, that's only going to fuel the momentum that we've been seeing in recent weeks and recent months.
What would take the market down between now and that Fed meeting? It wasn't the CPI. In fact, that only fueled the rally. If it's not going to be CoreWeave and Kava, it's hard to figure out what truly gets some profit taking here.
You know, it's going to be really hard. First, I mean, I love the Fed Fund stat because it's one I get to make fun of often. It's almost always wrong. Although at this point, I think it's got a pretty good chance of, being right. Even a stop clock is right twice a day. But I don't know there's a whole lot that's going to stop this rally. We're in the sort of summer sugar high, summer camp. The Fed is not going to talk to us for another 35 days or so. Even Donald Trump going to Alaska talking to Vladimir Putin is probably not going to take us down very much. I think the market just has a lot of demand for more stocks. It is concentrated, but that's dragging lots of things up. The rise of new products where you can play 2-3 times these through ETFs has really driven this market up. There's been a lot of demand, a lot of interest from retail. And I think very little is going to stop us outside of, that truly exogenous, unforeseen event that we probably don't want to spend a lot of time worrying about because we can't predict it, and it's going to be pretty bad if it happens.
Alex, is a 25 basis point rate cut from the Fed, if we were to get one, is that really a big deal for stocks?
Probably not. I mean, I think stocks have already priced that in. They've priced it in not just today. They priced it in a month ago. They priced that in 6 months ago. The real messaging there won't be the cut. It will be how many more cuts do we expect to see? As you pointed out, 2 years ago, folks were calling for 7-8 cuts in the course of the year. We saw none. Things were fine. But I do think we are seeing a lot of structural weakening across various parts of the labor market and in other concepts. And it's really going to be the messaging from the Fed. Are we going to take this thing nice and slowly down?
Ali, still, there's talk about a stagflationary environment. I don't see it. I mean, the economy is growing nicely. Inflation is what it is. I mean, we're not getting double-digit spikes in inflation, at least if you look at the CPI or PPI. I think it might be time to put that stagflation talk to bed.
Yeah, and you're not alone there, Brian. We had the Bank of America Global Fund Manager Survey. It was very bullish, very optimistic. The odds of a hard landing have basically evaporated at this point. But you are seeing some dispersion on the street when it comes to rate cut expectations. I just spoke with Morgan Stanley economist Michael Gapin yesterday, and he reiterated that call for no rate cuts this year, even after that CPI print. So really going against what the market is pricing. And he said it's because inflation does have momentum right now. We are drifting further and further from that 2% target that the Fed is chasing. And on top of that, we have a really tight labor market. Yes, the unemployment rate has remained low, but because of some of those immigration controls, the labor market is actually a lot more constricted than we previously had. So all of that is leading to his thesis that the Fed should remain on hold. And he's not alone there. We've heard that from other firms and some other economists out there. I think a lot of this is going to hinge on Jackson Hole and what Jerome Powell chooses to say, chooses to telegraph, and that could shift those rate cut odds a bit.
I wonder if Jerome Powell's going to go fishing. I mean, that's what they do here, right? They go fishing. If he catches a bass, maybe it's bullish for markets.
And we have Esther George now, former president and CEO of the Federal Reserve Bank of Kansas City. Esther, always good to see you. So the Fed is expected, they hold rates steady. Esther, first give me your take on that. Was that the right decision, Esther?
Well, I certainly supported that decision, and I think they telegraphed that pretty well, which is they were in a mode of waiting to see how the economy unfolds. And to be honest, Josh, they are really waiting to get some conviction around inflation to ensure that that is going to be coming back toward their 2% target.
When do you think we get that conviction, Esther?
Well, I think it's a great question. You're seeing the economy slow compared to last year. We see, I think, the uncertainty that has been plaguing the economy for the past few months playing out here. And the question is, you know, the economy is still growing. People are beginning to understand to some extent how to manage their businesses in this kind of environment. So the things that are pushing, I think, as upside to that inflation story have to do with the financial conditions we've seen, which have eased since the Fed's last meeting. We continue to see a lot of deficit spending coming out of the government. We're going to have a lot more Treasury issuance coming out here. And the direction of travel is to deregulate. So there are some things here that I think the Fed has to keep their eye on when they are trying to develop that confidence and ensure their credibility around their inflation target.
Let's say you're in that presser, Esther, that's coming up here, which we're all going to be listening to very carefully. And you're a reporter, Esther. I just made you a journalist. And you have the chance to ask Powell a question or two. What would be top of mind?
So I think I'd want to know from the chairman to what extent they really believe the current interest rate environment is restrictive. It is getting less and less clear to me that this policy rate is really dampening the economy. Certainly, we know borrowers always feel the brunt of these interest rates compared to where they've been over the last 2 decades, frankly. But all in all, the economy continues to move forward. And so understanding the Fed's calculus, I think, around where the balance of risk is as we go into the September meeting, I think will be something I'd want to hear.
The political pressure, Esther, that Powell has been under has been intense. I'm curious to hear what you make of it. And also, Esther, just I guess a more general question of how much that Fed chair matters when really, Esther, we're talking about, of course, 12 people who set interest rate policy.
Well, the Fed chair matters a lot. This is the leadership role for the committee, a very large committee, as you noted. It is one vote, but the real responsibility of this leadership position is to bring consensus, is to provide the leadership that says, how have we taken in the information, how are we reading the data, and how do we position our decision making for the long term and not just a meeting by meeting reaction to the data. So it is a very critical role. It's one that has to focus on the long run. And the design of this institution was intended to make sure that they were able to do that.
And yet we know, Esther, of course, President Trump is not going to be happy with the decision. I'm waiting for the social media post. I haven't seen it yet. I would bet good money it's coming. Does that Does that pressure, does it matter ultimately, Esther?
Well, I don't think it matters so much in terms of the committee's decision-making process. And again, you see today that differences emerge in this committee and our public so that the public understands where the debates are happening. But I think what's important, you don't want to confuse the public. And I do worry a bit when we see some of the disparaging remarks made about Chairman Powell and the Federal Reserve more generally. I wonder whether the general public understands the dynamics here that can affect their confidence in the institution. And that, I think, remains important for the Federal Reserve.
I don't know if you caught this, Esther. Mohammed Al-Arian gave an interview recently, and he was arguing Jay Powell should step down. The argument he was making, Esther, seemed to be, well, if he stepped down, that would actually it would diffuse a lot of this tension. It would minimize the attacks and would actually help preserve the independence of the Fed. What do you make of that call?
Yeah, I think the chairman, to be true to, again, the design of the institution, would be to carry and fulfill his term. I think that is really the demonstration of the independence of the Fed, the focus it's supposed to have. His term is not that much longer, and I suspect even whoever comes in behind him will have to face these same issues of thinking about the long-run interest of the American public.
Does the Fed, Esther, require reform in your opinion? I ask because, and you saw this, Treasury Secretary Bessent, he has called, and this certainly made headlines, got a lot of attention, he's called for a review.
Yeah, Josh, any democratic institution must be accountable and must be fully open. So I'll be interested in what particular reforms are being advocated for here. I think the central bank always benefits, and it's doing that now, right? Looking at its framework, thinking about what best serves the American public. So there's no reason not to hold the institution accountable. There's no reason not to think about whether the policy frameworks, whether the operating regimes they use are the most effective. But I would do that outside of a political leaning and try to do it in the most objective way possible in thinking about, again, how the public is best served by the decision making that goes on in this institution.
What about, Esther, I do want your take as well. An interesting thread here was the two governors dissenting. I was reading, Esther, that unusual. I believe it hasn't happened since 1993. What do you make of it? What does it suggest, Esther? What does it signal to you?
Yeah, it's unusual. I mean, I think we saw this when Governor Bowman dissented a few months ago, that hadn't happened in a while either. I think it's healthy. I think this committee, for too long, people have raised questions about whether its tight consensus looked more like groupthink than agreement. And that is not at all, I think, what the Federal Reserve is designed to do or intends to do. So I take these dissents at their face value, which is bringing forward arguments about a different way to look at the economy, a different policy preference in doing that. And the committee weighed those and came out in favor of leaving rates where they were today.
I'm curious what stood out to you and sort of the implications then for the Federal Reserve.
Yeah, Julie, I mean, clearly markets think that a rate cut in September is a slam dunk, but you look at this morning's report, and I'm not sure that's the case because core CPI, which is what the Fed focuses on, clocked in hotter than expected, 3.1% versus 3%. Remember, this excludes the volatile food and energy prices. That was up from 2.9% in June. And what the Fed's really looking for is the impact of tariffs. And when I looked at this report, you see a little bit of it, right? When you look at furniture, maybe shoes, not so much in apparel, which is surprising to me. And so it's not super perceptible when you look at this report, but services looked sticky to me. And services has been a concern for the Fed. It looked like it was coming in line. It was looking good. So this report looks a little bit sticky to me. I don't think it's enough for the Fed to make a decision at this point. We are going to get more data before the September meeting, but it goes back to what I've said previously on our air, and I'll say it again, which is that the Fed is in a bit of a dilemma right now. They're looking at both the inflation side of their mandate, which looks sticky. They're looking at the job side of their mandate, which is looking weaker. I think that the determinant factor for the Fed is going to be the September jobs report, the one that we get, or I should say the August jobs report that comes out on September 5th. Because if that is weaker, then I think that could be the trigger for the Fed to cut. But if we see a rebound from what we saw this summer, given that inflation looks sticky right now, I still see a majority of the committee in sort of that wait and see mode.
Well, and I'm gonna throw a further wrench into it. What if you see a rebound but a lower revision for July, right? Because so then do you just assume that August number is going to be revised lower as well? So just to
Right, and that also speaks to how the data is collected, right? We know that there's sort of a 3-month course here where the BLS goes out to companies, and maybe companies aren't responding until month 3, and that's why we're seeing such large revisions in the data. And to your point, you know, that's what we've seen consistently all year. So we'll probably see another revision down.
Yeah,
I mean, do we go negative?
Right.
You
as Claudia Sahm said, you know, in the last half hour, the Fed's job is never easy, right? So, but maybe particularly not right now. Jen, I also want to talk to you about this new nominee for Commissioner of the Bureau of Labor Statistics, E.J. Antoni, who is at the Conservative Heritage Foundation. Economists don't seem thrilled about this pick, and there is this fear amongst economists that there will be sort of the partisan thumb on the scale when it comes to data.
Well, remember, Julie, like I said, I was watching whether the nominee is someone who's going to change the process of how data is collected and how things are done versus just simply putting somebody new in to oversee, as we saw with McIntyre prior. And with this new nominee, Antoni, you know, he has been a longtime critic of the BLS and how the BLS collects data. And he said there are better ways to collect data and process and disseminate it. And that is going to be the next job of the BLS commissioner. So now that he is the nominee, you know, we're going to have to see what he's going to do. Now, he has to be confirmed by the Senate. So the Senate is going to be peppering him with questions, I'm sure Democrats more than Republicans, about what he's going to do, how he could change the process of data collection. Certainly there are improvements that could be made, but the question is, you know, could this be slanted in a way that would be partisan to make the numbers look better, which is what investors have been concerned about, and questions over how could he handle a report that perhaps the president doesn't like.
Right. Good questions all. Ramson, I know you've been looking at some of Antoni's past commentary. We were talking about this a little bit in the last hour, that he's been a critic, but it's not clear how he would fix it, right? Or how he would change it at this point.
That's right. I mean, it's clear he's a Trump ally. You don't have to be a genius to work that out. He has called the data from the BLS back in May. He tweeted and said on X, he wrote, you know, it's like getting a random number generator. He's called the CPI data under Biden phony baloney. So he's clearly, you know, agrees with President Trump on a lot of things. And that's what the worry is, that the Senate he does need Senate approval. And his critics are worried, though, that he's not going to be neutral enough. And don't forget, non-farm payroll data is often revised. And in fact, in the run-up to the November 2024 elections, the big revisions, some economists and statisticians would tell you they hurt Trump's opponents more than they hurt President Trump. So it's a really tricky one. He's definitely going to get grilled by Democrats, but don't rule out any Republicans also asking him some tough questions as well. Don't forget the number of staff he's going to be in charge of is just 2,000. It's not a lot, and we're in a period where President Trump is trying to cut jobs in big agencies. So this is going to be a tricky job, whoever took the job. But he's going to come under increased scrutiny as he's seen as sort of a big Trump ally as well.
Right. And economists have been calling for more resources at that agency, not less. So, Joe, I'm going to go to you first. What's your first blush reaction here to these numbers?
The core inflation, it came in a little hotter than expected. Moreover, the top line was flattered by a 1.1% decline in gasoline prices. So once we begin to dig deeper, what my sense is you're going to see goods inflations moved up and sticky service sector inflation. This is not conducive to arguments that there's no inflation via the trade channel. Basically, tariffs look like they're going to be all over this report.
And Claudia, this would seem to make the Fed's job a lot tougher.
The Fed's job is always tough, but it's certainly, we do see an inflation moving up, but in terms of the component for them, if it's largely this tariff effect, if it's a goods effect, well, then that is something that there's a case to quote unquote look through it, like that we're doing a one-time price adjustment and that'll cause rising inflation. But once that adjustment's done, it'll subside. The core services numbers did firm a little bit relative to last month, but really they've not seen the pickup. Like this is really coming, you're getting the lift is coming here from the tariff effects.
To your point, I'm noting in here the index for shelter was up 0.2%, and the statement saying that was the primary factor in the all items monthly index. So that perhaps, Claudia, particularly problematic here because we had been looking at that number moderating.
Right. Well, that actually a 0.2% for shelter, that's a good number. It's just shelter looms so large in the CPI that it's going to be a big contributor of inflation. So I think actually the shelter is doing what we had actually been looking for it to do for quite some time, which is kind of get back to a pace that is pre-pandemic. So I think that one actually here looks pretty good, but you're right. It's the big piece of inflation, and for regular people like the housing affordability, all of those issues that looms large, no question.
I'm also looking at some of the other commentary here. Indexes that increased over the month: medical care, airline fares, recreation, household furnishings, as we were looking for, and operations, household furnishings and operations, and used cars and trucks as well. It looks like the indexes for lodging, away from home, and communication were among the few major indexes that decreased in July. Colin, I want to get you in here on this as well, and sort of how you're thinking about the effect on the rates market and the Fed also by extension.
Yeah, well, I think Joe and Claudia both made some really good points where we don't just want to look at those headline numbers. We want to look at the breakdown between goods and services. And because services really do make up a much larger share of inflation than goods do. So I agree with Claudia that we see the tariff impact in goods. But what is the impact of the softening labor market? What's that going to do to the service side of the equation? Because if you look at tariffs, that's trade policy. That's not really monetary policy. The Fed can't do too much there. But if we start to see more of that softness in services, in consumer spending, in the cyclical areas like that, I think the Fed might start to focus right there. But just looking at this number specifically, a core reading of 3.1% year over year. Obviously, there's so many numbers that we can point to. That's probably going to scare some officials because we have a number of officials who are talking about the weaker labor market right now and hinting that they might be open to cuts, some more explicitly, others more implicitly. But then there's others who are talking about the fact that inflation is still too high and frankly above target. So I'd say this probably does confuse the outlook a little bit, and we'll have to see how the PCE report and then the August CPE release comes out.
Right, and that's a good point because we all focus very heavily on the CPI report. It is important, but the gauge that the Fed focuses most heavily on is that PCE report, which we don't have yet. Joe, I can see you busily on your phone over there going through all of the numbers. Right. I know there's some stuff you want to focus on.
Core services ex energy was up 0.4%. That's 3.6 on a year ago basis. That's that sticky service sector inflation that we worried about. Moreover, you can see it in transportation services, which jumped 0.8%, as did medical care services. After increasing 0.6% last month, it's up 0.8%, and that's up 4.3 on a year ago basis. As I'm digging through the data just here on the first blush, guys, this is a meaningful increase in inflation. This is going to require a reconciliation of the Fed's dual mandate. You've got inflation rising, you've got job gains that are going to probably continue to be soft. This is going to create a real problem as we head towards the September meeting. Now, my sense is that when you get a challenge of the dual mandate, you get tension inside of it, you lean towards the period, or the portion that's furthest from its mandate, and that's inflation. So that means more patience, not the 80% chance of a rate cut that I saw in the federal funds market before we came on air this morning, right? Moreover, look, service inflation looks like it's just real sticky. And we're not really seeing the big pass-through from tariffs just yet. This is when we thought it would start. We've been able to see it in the granular data, apparel, toys, appliances, that sort of thing. And with the tariffs finally being set, the effective tariff is 17.6%. It's going to start showing up materially in October, November, December. This is not the easy layup.